Welcome to How to Retire on Time, a show that answers your questions about all things retirement, including income, taxes, Social Security, healthcare, and more. This show is an extension of the book, How to Retire on Time, which you can grab today on Amazon or by going to retireontime.com. My name is Mike Decker. I'm the author of the book, How to Retire on Time. I'm also a licensed financial advisor, insurance agent, and tax professional, which means when it comes to financial topics, we can cover it all. Now, that said, please remember this is just a show. Everything you hear should be considered informational, as in not financial advice. If you want personalized financial advice, you can request your wealth analysis from my team today by going to www.yourwealthanalysis.com. With me in the studio today is my esteemed co-host and colleague, Mr. David Franson. Thanks for being here.
Yep, glad to be here.
David's going to read your questions, and I will do my best to answer them. You can always submit your questions anytime during the week by texting 913-363-1234. Again, that number is 913-363-1234. Let's begin.
Hey, Mike, how can I avoid or reduce my taxes on RMDs?
Okay. So the question really revolves around, what do you do with your pre-tax dollars? Let's talk about that for a second.
Okay,
all right.
right.
So pre-tax dollars, that sounds like jargon. Think of your 401k. Think of your IRA. For years, you've had this career where you're deferring taxes to a later date.
Yeah.
Deferring taxes. Let's say you make $150,000, but you've deferred $20,000 of your salary into your 401k, so you only paid taxes on the lesser amount, $130,000. You see that? It's like, oh, I want to pay less taxes now, and I will defer it to a later date.
You reduce your taxable income, right?
Yeah, which is great.
Yeah.
If you don't need the income, pay less in taxes. That was the idea, at least in the 80s and 90s and 2000s. They're like, oh, your retirement income, your taxes should be less in the future, so why not do this? And in theory, that made sense.
Mm-hmm.
But theory doesn't always become reality.
Sure.
A lot of people today are sobering up to the idea that they might actually be forced into higher tax brackets. So the question is, how much income do you need in retirement, and where are the assets? And if you don't need the assets, the government said, oh, well, we want to get paid. That's where the required minimum distribution starts. So around 73 years old, they do keep changing it. So whenever you're listening to this show, if you're a podcast listener and you're listening to it 2 years back,
Right.
check the actual date, because these things do change. But right now, is the time of the recording. It's 73 years old is when you need to start taking out distributions. That's a problem. What if you don't need it?
Mm-hmm.
The government wants to get their taxation. You've deferred taxes for a longer term period of time. And in some sense, it's a good deal for you because you grew these assets without capital gains issues. But in some sense, it's also a huge detriment. It's like, oh, I've grown a small amount of money to a larger amount of money that now has more taxation.
What's the government's justification for sort of forcing you to take a distribution later in life?
That's a great question. So the way it was structured, the 401k and the 457 and the 403b and all these compensation plans, packages, employer plans, basically.
Yeah, right.
Is, hey, let's incentivize people to save money into an account. We'll give them tax benefits, but they can't take the money out until retirement. There isn't really a social government pension for everyone. You could say, oh, well, that's Social Security. No, Social Security was originally invented to help people who lived past their date of death to keep going.
Yeah.
I mean, back in the day when Social Security existed, you were kind of supposed to die before you could qualify. So the few people, it was a security blanket in case you happen to live longer. We just happened to not increase the age of Social Security with the increase of our life expectancy. And now people say, well, that's like a government pension. It's not. It's a security blanket for those who lived longer that did not keep up with times. And really today, it should maybe cover 30% of your retirement income needs.
Yes.
I know a lot of people live off of Social Security, but that's not what it was originally intended to do.
Yeah.
Now, if you go to places like England, they will force you to go into a government pension program to force them the payouts. And it's, this consolidation, it's not necessarily a good or bad thing. It just is, right?
Right, sure.
These are financial mechanics to create financial structures. But in America, we don't have that. And then along the way, pensions were the tried and true way.
Yeah.
But they realized in the IRS code that you could defer responsibility as a business and say, we don't want a pension for the lifetime of our employees. We can just say, hey, put money in here and it will be your responsibility.
Yeah, correct me if I'm wrong, but the pensions are sort of a large expense for these corporations.
You could say that. Many would argue that. I think there's an argument both sides to this equation. I think it could be run rather efficiently and effectively. I think it could be run horribly. I think pensions are a very sustainable way for everyone. I think most people like pensions, but they don't work for the current business model. I mean, the average person in tech, I think, works at a business for 18 months. The work environment has differed, so pensions don't really work unless you really want to work at one company for 30 plus years. Work there, get the watch, the clock, whatever, and retire. So
that's right. That's what I'm banking on for Kedrick, by the way.
Yeah, we're not doing.
Work my way up.
Ignore everything that we teach here on how to create your own income. We'll just create a pension plan for our. No, you don't have a pension here. Hey, you could buy lifetime income.
Oh,
please don't. For all the listeners, by the way, if you don't realize that the subtle sarcasm there, the whole book was written to argue against the lifetime income stream by an annuity, in case you didn't pick up on the sarcasm. But I digress. So we've shifted over to the 401k. We've deferred taxes into a self-made plan that has a 10% penalty until retirement with the intention that you can save money. It grows tax efficiently, but at someday you got to pay the piper. And the government said, we don't want to wait until you die to get our money. We want to force you to take distributions out. That's why the RMD exists.
Yeah, government needs this money to keep funding all its stuff. Yeah.
Which is fine.
Yeah.
I really appreciate the infrastructure we have in this country. I like nice roads. I like a fire department. I like having police patrol the community. I live in a very safe community. I love it.
Yeah.
And these are things that I think are appropriate. Now, whatever. Some people might get upset with me saying that. Look, there's always be a few bad apples in every organization, whatever. Sure. But I like police. I like having that. I like having our general first world infrastructure.
Yeah.
Okay. It's nice.
It is.
You have to pay for it some way. That's what taxes are. I don't think anyone's upset by paying taxes. They just don't want to pay more in taxes than they need to.
Sure.
So the RMD forces you out. Here's the crux of the question. How do you take out your RMD or your taxable account? How do you pull money out of your pre-tax account efficiently? The overarching, oversimplified consensus of this is to just do IRA to Roth conversions. So you retire and then you start moving funds over from your IRA to your Roth. Roth accounts don't have an RMD associated with them because you've already paid the taxes. It grows tax-free, it pays out tax-free. The government says, we don't care about that, right? So it's really the pre-tax. And that may be a solution to you, but this is what bugs me, is a lot of that is fear-mongering into this idea that you need to do IRA to Roth conversions. You might not. So there's a couple of layers here. Make sure I don't forget any of them.
Okay.
You've got, first off, the income planning element. Do you need to do IRA to Roth conversions or not? Then you have your legacy element. Let's do the legacy one first.
Okay.
Let's say you've got a pension.
All right.
Let's say you've got Social Security, and that pays more than you ever really need.
Sure.
At that point, you don't really need more money. Maybe you want to grow it as much as you can, and you don't care about the RMD. When I say you don't care about the RMD, and the reason is, you might pay an RMD, fine. As your assets grow, you pull the RMD out, then you reinvest it, and then you don't touch those assets, and they grow, and then when you pass, everything gets up a step-up basis on the brokerage accounts. Your RMD passes, and then they get those assets. It's not really a huge issue.
Yeah.
So when you hear this, you've got to do IRA to Roth conversions and prepare for the RMD because you're going to get double taxed if you don't. If you don't intend to touch your money until later, then it's not really a big deal. I've had plenty of calls where they'll just say, hey, I'm just focused on legacy planning. If you're focused on legacy planning, you don't want to take a hit to your principal by paying taxes and moving funds out.
Okay. Yeah. Explain that a little bit more there.
Yeah. So, okay, let's just simplify tax code for a second. If you've got $1 million and the IRS simplifies the tax code and says you can convert everything over today at 20%, or you can do 15% for life, what would you do? All things being equal, same performance, same net income, all of it being the same. The person that did the 20% upfront paid $200,000 in taxes. Okay. They paid less in taxes overall. The person who did 15% for life, they paid $412,000 in taxes in this situation. You with me so far? So they paid much more in taxes.
They paid more, so immediately my gut reaction is, that's bad.
Yeah, but because they slowly paid taxes, they protected their account balance.
Right.
It's easier to grow money when you have more money to grow. So the
Yes.
higher balance compounded, and it ended up being around $690,000 more dollars. So if your intention for your IRA assets is really more focused on legacy than income, then you might actually not want to do many IRA to Roth conversions. You might not want to prepare for your RMDs because your intention is to just grow the principal, the total account balance as much as you can. And yeah, you're going to be forced to higher tax brackets later on. Maybe it's a detriment, maybe it's not. You don't know the future, but you're really just paying the taxes, moving it over into a tax efficient buy and hold vehicle. And then you're buying that and holding it. You're not getting double taxed because you're not touching the asset. It's growing, and then the non-qualified assets pass on to the beneficiaries with a step-up in basis, so you're not taxed on the gains. Your other assets pass on the beneficiaries within the IRA assets, and then they have 10 years to grow it and take the distributions.
Okay.
So this idea of, oh, everyone should do IRA to Roth conversions, well, hold on, let's stop there. Now, if you don't have kids or you don't want to give your kids that much money, and your intention is to grow and do something good with the money, you can just donate the asset, your RMD, each year.
Okay.
And pay no taxes on it. So there's, again, what's your intention? What do you want your money to do for you?
Yeah.
Now, let's say you do want to spend the money. That might make sense from an income standpoint. You don't want your RMD to be greater than the portfolio income that you want. So let's say you want around $50,000 from your portfolio.
Okay.
And your RMD is $60,000. That's not efficient.
No.
Because you have $10,000 of additional income. You got to put it somewhere. So what do? You put it then in your brokerage account. And then if you want to touch that money later on, you're taxed again. That's the double taxation that will get you.
I see.
So this is where then you line up your income. How much do you want? And then you start saying, okay, could you spend down the income at the beginning and delay your Social Security so that RMDs are not an issue?
Oh, right.
Maybe they are, maybe they aren't. I recognize that. We're covering a lot here, but if you retire at 60 and you file at 70 years old, you're going to take more out of your portfolio during those 10 years.
Yes.
That could lower your IRA assets, your pre-tax dollars, enough that once you turn on Social Security, your RMD is the income you already need. Therefore, it's built into your income.
Okay.
If that's not enough, you could then do IRA to Roth conversions, kind of coordinate it so that it's more efficient. But do you see how this idea of, oh, I want to pay less in taxes, I want RMDs, that's not the only question you need to be asking. There are multiple layers that you need to address when you're going to really tackle efficiencies from this position.
Yeah, it sounds like there's a lot of planning, and you have to think ahead, think about what your intentions are, legacy, what have you, income needs, forecast it out, and then be intentional.
Yeah, it's everything you do will affect everything else you do in retirement planning. There is a ripple effect.
Right.
You can't throw a rock in the water and then kind of conceal the ripples. Like that doesn't work that way.
Right.
And even to the extent of, and a lot of people don't go to this level of detail, but this is how I really like to nerd out when it comes to taxation and income planning, is if you can coordinate your RMDs to be around, let's say, $20,000, $30,000, $40,000 total of taxable income. What's your standard deduction? Around $30,000. So what you've done is you've taken your total taxable income. Yeah, it's taxed, but you got the standard deduction, so it's kind of like it's tax-free. And then there's a ripple effect then on your Social Security, which could then be tax-free, and other ways you could manipulate your whole situation. So your RMDs would then be tax-free, which is kind of what, like, the question and how this was posed.
Yeah.
How do you avoid paying taxes for your RMDs?
Yeah.
It's the preparation beforehand. You don't show up and it works. This takes years of planning and execution to get there. But a lot of really cool stuff could be built around RMDs. The point is, when it comes to RMDs, you do not want to have your RMD back you into a tax corner that forces you to pay more in taxes on assets that you want to touch later on, and then you end up being taxed twice. You don't want to be reactionary. You want to be proactive, and it takes planning to do that. And a lot of the points I talked about today are, in my opinion, not discussed enough. The planning your RMD to fit within your standard deduction or your taxable situation based on how you file your taxes.
Yeah.
That your RMD and your charitable intent or your legacy planning, how the RMD fits in there.
Why don't people ask these questions or talk about this as much, do you think?
A lot of financial planning companies in their disclosure say they can't offer tax advice. I think that's a problem. I think there is an issue in trying to separate taxes, insurance, and investments.
Mm.
Because what you're doing is saying, well, this is what I do, but I can't give you that advice. Find someone else. Then you have disconnected advice.
Everything's in silos.
Yeah.
Yeah.
You got to be able to connect.
Break out of those silos.
Yeah. Break down the wall.
There you go.
Right. Go listen to Pink Floyd and then call us.
Yeah.
But the truth is, finance is complicated. There are ripple effects. There are consequences to what you do today that you won't or may not realize will happen until 10 years from now. So you've got to look at this holistically. You got to know where you're going. I had an old professor years ago that had a great expression that said, if you start right, there's a good chance you'll end right. But if you start wrong, you're probably not going to get things back on track.
Yes. It makes it just that much harder if you're starting wrong to sort of right the ship, right?
It's painful to course correct.
Yeah.
It really is. That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcast. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about Your Wealth Analysis and what it could do for you, regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.